Yes. So the index that you're referencing is the Market Vector GammaRoad U.S. Equity Strategy Index, and we partnered with Market Vector to launch that index in December of 2023. And the index and the strategy underlying the index seeks to deliver total returns comparable to the S&P 500 over a full market cycle or over multiple market cycles. So it's really intended to be, a long-term strategy. And it does that on the basis of three unique drivers of market risk for the U.S. equity market. And specifically, those three drivers are behaviorally based, which is consumer confidence. We've got one that is based on economic strength, which looks at cross-asset relationships. And then the third measure is a pure price trend measure of the overall S&P 500 itself. And so these measures are measured as either bullish or bearish for U.S. equity market risk. They're measured on three distinct time horizons. So the consumer confidence is measured monthly. The fundamental economic strength is measured on a daily basis, and the price trend measure is measured on a weekly basis. And these are combined to determine whether the strategy allocates to S&P 500 exposure, T-bill exposure, or some combination.
So the index right now, what is it telling people who are just paying attention to the index? What is it telling them they might wish to do?
So at the moment, the index is positioned with one of its three measures as bullish, so fairly conservative from a risk-taking perspective. The price trend measure is the sole bullish measure right now. And the story through the framework of these three measures is quite fascinating coming through 2025, the way it has unfolded. So if you recall, we came into the year really on the heels of a fantastic two-year run in the S&P 500. And so we entered the year with the strategy's three measures unanimously bullish. And so the strategy was at its maximum equity exposure. In late January, our measure for consumer confidence turned bearish. And so the strategy reallocated to a third T-bill exposure and two-thirds S&P exposure. In mid-February, then, our measure for economically sensitive assets turned bearish, which is indicating fundamental economic weakness. And so the strategy reallocated again at that point to two-thirds T-bills exposure, one-third S&P 500 exposure. And then in mid-March, as volatility was starting to pick up, the price trend measure turned bearish as well. And at that point, all three measures were bearish, which means the strategy was allocated entirely to T-bill exposure. And so it was at 100% T-bills coming into and through the tariff tantrum and the volatility we saw in April. And then the rebound that we've seen, the impressive rally off the April lows, was sufficient by mid-May to turn this price trend measure bullish once again, at which point the strategy re-risked and took on a third S&P 500 exposure and two-thirds T-bills exposure.
When I hear about treasuries, I'm thinking of, I had a conversation, I was very fortunate, and I'm dropping a name here, but Rick Rule, who some people may know, who was telling me, man, if you're not, regarding treasuries, short only, beware, beware. But I want to read something to you. I follow her on X, Kate Long, who, when I was at Fox, I first met her, and she follows all kinds of investment strategies, but especially treasuries. And she just posted this on X. So by the way, if you're watching us on X, you can put your questions in for Jordan. We will make sure to ask Jordan your question. But Kate writes, foreign investors holding U.S. treasuries held close to a record high in April, despite the turmoil in financial markets in the wake of President Donald Trump's Liberation Day tariffs. Quote, the sell America narrative is an over-exaggeration. What do you think? I realize that we're talking about the index, but what Kate has just pointed out, it seems to fly in the face of the narrative that we keep hearing from what I like to refer to as the pontificators on CNBC and Bloomberg, and where the data becomes much more important. And your index is driven by the data, not the pontificators.
Yes. So rates and the shape of the curve are not an explicit input into our strategy. I think there's some mixed evidence in the data. I think, as we've seen time and again, that the media narrative to a degree can be overblown. I would certainly keep an eye not only on the data that the Fed publishes in terms of holdings at the Fed, but I would also look at currencies and look at that as an indicator of capital flows. And we have seen some movement. We have seen some weakening in the dollar that can be suggestive of foreign investors leaving US dollar-based assets. But it's been a very short time period, as you point out. And while the moves on a day-to-day basis may have seemed somewhat meaningful, you can squint at it on a long-term chart. So really remains to be seen from a market pricing perspective where that will shake out. It does identify a very important design decision that we had in developing the architecture of the strategy. And it goes back to the Rick Rule point you made earlier. And by the way, huge fan of Rick Rule. Love that you've spoken with him. Very insightful. I would encourage anybody watching this to find anything and everything that where he's been interviewed. But we had a choice, which was, well, if you're going to allocate to an alternative to S&P 500 exposure, and that's the strategy expressing the risk-averse part of the strategy. Traditionally, you would find that most conventionally based portfolios would look to long duration treasuries. And they would do that on the basis of the last 3 decades, where we saw time and again that when meaningful equity volatility picked up, the long end of the curve provided diversification. In fact, that's the basis for how many conventionally built portfolios, 60-40 portfolios, balanced funds are built, right? They're predicated on this diversification benefit that the long end will provide if equities sell off. What we're finding in this environment, and really since 2021, is that as we've seen this upward pressure at the long end of the curve, you begin to see a change in the correlation between equities and fixed income, specifically treasuries. And in fact, in an environment like this, historically, the last 25 years are not the reality. That's actually the anomaly. And in an environment where you have significant upward pressure on the long end of the curve, you have increasing inflationary expectations, and you combine that with a weaker growth outlook, you can actually find that there's a significantly positive correlation between equities and long duration. And that's why we chose T-bills to stay, as Rick pointed out, as short as possible when you're not expressing equity risk.
So I want to talk about the index again and how you designed this. And again, remember that I'm a Luddite. If I ask you a question, because there are compliance regulations, and I don't want to be hawking anybody's product, but I do want to mention this index. I want to hawk your index. Where did you get the idea to do this? Because you were an institutional investor, and you could have, ridden that to Easy Street for many years. Why do this?
Well, being on the institutional side and being the chief investment officer for a private foundation for a family office, working at a large corporate pension fund, you have the benefit of having quite a few investment strategies pitched to you, a ton of research coming your way, and a common facet or personality trait of so many of these equity-based strategies is that they are really designed to do well only in one part of the cycle, or in one type of economic regime, or under a certain set of capital market assumptions. And they become particularly vulnerable when you get these very deep, prolonged downturns like we've seen historically for the S&P 500, or really for any equity index. And so the motivation there was to bring something to market that can attempt to navigate that, and to do it in a completely systematic, rules-based, objective fashion. So there's no discretion involved here. There's no decision-making in a discretionary sense. This is entirely based on these 3 measures and their objective of measurement at any time. And it requires quite a bit of intellectual honesty with oneself, frankly, to put your faith in any one measure of how favorable the equity market might be at any point in time. Because 1, it's a very, very challenging endeavor. And 2, we're all built with human bias, right? And the more time we spend working on something, or the more time that we convince ourselves that something's a good idea, right? It's easy to convince yourself that research looks compelling when in fact it may be highly dependent on a specific market environment or part of the cycle. And so, the motivation here is to bring something objective, rules-based, that is repeatable and trustable over multiple market cycles.
We mentioned Rick Rule. And in regards to that confidence, I asked Rick a question when I interviewed him for something else. And it was a comment he made in which he does not expect the dollar to lose its reserve status, but he does expect the US dollar to lose its hegemony. And I asked him to explain what he meant by that. And he said, look, they're still going to transact in dollars, but our ability to lead is diminished every day. And the kinds of things that President Trump just said, or even people who attack the Fed, is that's what's chipping away at U.S. hegemony with the dollar?
I think to a degree. It's also important to recognize that if you follow capital flows, you follow developments in the global currency markets. This trend or this movement to reduce the dependence on the dollar by non-U.S. dollar market participants, has really been in play for over a decade right now. I don't know that we have time to go into all of the details of that, right at this moment.
Sure.
But suffice to say that, I would agree with Rick at the headline level in the sense that, something that takes decades to build up does not change overnight. I think we live in a very short-term reality these days, and so folks expect those things to change overnight. They don't, but we can clearly see, central banks outside the U.S., large institutions outside the U.S. taking slow but deliberate and meaningful steps to reduce their dependence on the dollar from an investment portfolio exposure perspective. But then also you see it economically, and you see fiscal policy around the world increasingly moving in that direction.
So as I start to wind down with you, I want to ask you again about the index. People like me, and I refer to myself jokingly as a Luddite, but I think I'm a pretty average do-it-yourself kind of investor. Your index, will others start leveraging the index? Will you be creating other indexes to be leveraged so that we can take advantage of those should you go into partnership with those who can bring us the tools?
Yeah, so the long-term plan for our firm is certainly to do that. Appreciate the question. And everything we will do will have certain common principles. First and foremost, they will look to mitigate or outright reduce risk. That will be whether it's applied to traditional beta exposures across asset classes, or in more of an absolute return sense to diversify traditional beta exposures in portfolios. And so some of the strategies that we plan to bring to market will be applicable in a publicly listed way. And others really will only be, applicable more under a licensing model and, in a private sense. Again, more of a conversation for another time. But certainly the long-term vision for our firm is to remain rules-based, to remain objective, and to bring these rules-based strategies to market.